Kids' team sports are awesome. They're learning new skills, making new friends, and as parents, we get to meet some pretty cool moms and dads too. Saturday and Sunday mornings for us means we're at the early rink time with our boys. They spend most of the time at practice, learning skills, and then at the end, it's game time. At this age, hockey is about one thing. It's the puck. Wherever it goes, so does our buzzing, smiling swarm of kids, all chasing that shiny object. And here's where the challenge lies. The moment the puck squirts loose and goes the other direction, the whole team gets caught off guard and chases it the other way. Funny enough, Timbits Hockey is a lot like investing. We're all tempted to follow the shiny object, that latest hottest stock, the next big thing. Just like the kids chasing the puck, we know exactly where the action is right now, but we have no clue where it's going to go next. As the players grow, they're going to develop systems, they're going to learn to hold positions, trust their teammates, and work as an organized unit. In wealth management, we call that diversification. It's been described as the only free lunch in finance. Different investments perform well under different conditions, and by spreading our investments over various asset classes, we reduce the risk and improve our long-term outcomes. Of course, diversification does have a catch. As Brian Portnoy says, diversification means always having to say you're sorry. Why? Because in any well-balanced portfolio, there's always going to be a best performer and a worst performer. When the markets rise, the safer parts of your portfolio are going to feel like they're holding you back. And then when markets fall, that growth-oriented part might feel like it's too risky. But over time, this approach tends to lead to better results and more stable results. Lately, we've seen a lot of money lost in alternative investments. They were the shiny objects that seemed like a guaranteed win in 2022. But those who stayed the course in more diversified portfolios, well, they've generally done better. So what's the lesson here? Investing isn't about chasing the shiny object of what's already happened. It's about planning ahead. Here's what you can do to stay on track. Build a diversified portfolio, tailored to your long-term goals. Follow a rules-based and repeatable process and rebalance annually. Trim the winners, add the laggers. As we head through this year, there's going to be plenty of noise. Elections, war, tariffs, the state of housing, the economy. These are all real-time known unknowns. We can't predict every event, but we can prepare for these uncertainties. Much like Timbits Hockey, the instinct is going to be to chase the puck, but the best players and the best investors know that you have to stay in position, follow a plan, and take advantage of the free lunch that diversification provides. To be right for the right reasons over the long term means we have to be willing and embrace being wrong for the right reasons over several incremental short terms. That's the game, and that's how you win.